Hello, everyone. I hope you're having a wonderful day. I'm excited to be here because my whole goal is to educate you. I want to educate you on all of the inside and inner workings of the mortgage industry so you can understand better about what is involved, what goes on, and things of that nature when it comes to mortgages. There's a lot of misconceptions, a lot of misinformation, and just the amount of just selling versus actually advising consumers out there, even real estate agents, to be able to advise and educate your real estate agent partners or whoever you're working with so that they're also giving the right information and not giving false information as well. So I want to be able to educate you, share all that great insider information. So today, what we're going to be going over is rate pricing. So how are rates actually priced? So we're just going to go ahead, dive right into it so that you can understand better what's involved in pricing a rate and a whole bunch of factors around that. There's quite a bit involved, but I'm going to go ahead and share my screen and we're going to jump into it. So the first area that we're going to start here is right up here. So who sets rate pricing? So number one is investors. No one else. Starts point one with investors. Okay. Then there's loan level price adjustments, which is number two, LLPAs. And then number three is going to be lender margin. Okay. So the first one, investors, I want you to think of open market. Okay. So it's like an open market. Imagine that said price is what investors have determined they're going to pay. So all investors have determined they're going to pay for said loan. Loan level price adjustments, which are set by Fannie Mae, Freddie Mac, or lenders for Ginnie Mae loans. Most lenders, very few, don't set LLPAs, which is a very bad business model. Those loan level price adjustments are going to be for, like right here, you'd see like loan amount or loan to value or combined loan to value, CLTV, LTV. Loan purpose, waiving your escrows or not, your credit score, your DTI or debt to income ratio, your occupancy. So are you a primary residence? Is this an investment property? The property type. So maybe a condo versus a standard single family home. There are some differences between lenders. So lender discretion on location. So let's say you're a very large lender and you are looking in, all different markets of the country in all 50 states, and you see some are more competitive than others. You may have some lower margins or better pricing in other areas or in certain areas than others. Okay, so you may have, I'm just going to use two random places. I don't know, Baltimore, Maryland versus uh, Kansas City versus Kansas City. Okay. And you may say, oh, Kansas City is not that competitive. Not saying it's not for anyone in Kansas City. Just a random example. Okay. But let's say Baltimore, Maryland is super competitive. So that lender may say, okay, we don't have to be as competitive here. So we'll take a larger margin in this area of the country and we'll take a lesser margin, in Baltimore because it's more competitive. We just have to be more competitive to get more loans. And due to the fact that we're going to get more loans in this area, we also are going to make up for the fact that we get less loans in this area. Again, we'll say it's Kansas City. So if we got 50 loans at 2.5% margin in Baltimore, but we got half the amount of loans in Kansas City, we'll end up making more money in Baltimore because we just did the sheer amount of loans we did helped us profit more. So again, some lenders are like that. Some aren't. Some have just set pricing. It doesn't matter where you're at in the country. Here's our set pricing. Okay. And then Ginnie Mae. So these are government-backed loans, FHA, VA, and USDA. There aren't loan level price adjustments from the FHA, VA, or USDA. So they don't have any. It's just like, here's the loan. Like, here's the rate pricing per se. But investors will say, hey, I want to pay less money for a FHA loan with a 620 credit score than I do for an FHA loan with a 680 credit score. So due to that, lenders will most of the time set loan level price adjustments for different credit scores or certain criteria of these. Okay. All right. So now we're going to go ahead into how is a loan sold. So let's say the closed loan amount is $100,000. Okay. So the lender goes ahead and charges their credit card, which is their attached to their line of credit with the bank. So random bank, BB&T, first one that popped in mind. So we'll say BB&T. So I'm going to go ahead and charge my card that's attached to my line of credit with BB&T for $100,000, and I'm going to wire those funds over to the closing. So I've wired those funds. There goes $100,000. Okay. Then what's going to happen is the lender's going to take that loan and they're going to go to the open market. When they go to the open market, they're going to go ahead and sell that loan. And the investor is going to pay them whatever the cost of that loan is on that day. And then that's how a loan gets sold. So there you go. So what if price changes at closing with investors? So if pricing gets worse, lender's out that money. If pricing gets better, lender just gains some money. So it's risk and reward for both the investor, but also the lender. So it just depends. That's why a lot of lenders like to put in some sort of buffer in their pricing. So let's say we're in a volatile market. The idea for a lender, what they ideally should be doing is putting in a little extra buffer. Because if we're in a volatile market and you're taking this loan to open market, but the price is, less from 2 weeks ago, or we'll call it a month ago from when you locked the loan, oh shoot, now I'm going to make less money on the loan. Thank God I had a buffer. But if you're in a low rate environment where where rates aren't volatile, we know rates are going down. Well, great. I can eliminate this buffer that I have or that I had in my loans because I don't need to worry that much about, well, I don't even need to worry at all because rates are going down. That when I take this loan that I locked into open market, I'm probably going to get paid more for it. So you can be a little bit more aggressive on your pricing. But when rates are volatile, rates are going up, oh shoot, rates are going up. So where I'm locking, I might not be able to sell that loan at that price in 30 days or 45 days or whatever it is from now. So you're either out or you gain, but it just depends. You typically want to put in some sort of buffer. That's why extended locks are very, very risky in this market. Because if you do loans that were on a year extended lock back in January, but let's say they're closing in November, well, you see where rates are now compared to January. I mean, we're at least, 2.5%, 3% higher. Holy moly. When you take that loan to open market, you're going to be in the negative. So you're losing all your margin on that loan. You're digging yourself a hole. Okay. So again, that's why lenders will typically, if you can, build in some sort of buffer into their margin on loans in a volatile market, and then recoup, when we get back into the lower rate markets. So we get to be a little less, we recoup a little, then we be less aggressive over time, and we don't need to worry about the buffer. We just eliminate it. Okay. So what happens to lenders who cut their margin or choose not to have a buffer in a market like this one, a rising rate environment? So the 8/1/22, we're technically in a rising rate environment, even though we have seen some pullback over the past couple of days. And it's a very volatile market. Rates have gone up and down and up and down and up and down. And so smaller shops, you would actually see close or go out of business. Why? Because they don't have the capital to keep up with this volatile market. They will go take these loans to open market and just be negative, 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 negative. So they're just losing money from their line of credit every day. And it's just a matter of how far can you dig yourself into a hole until rates go ahead and then they, go back down. Are you going to be able to recoup from that? Most can't, especially the smaller shops. Now, bigger shops, for the majority, lenders will need, so essentially what I have here is lenders will need to keep rates or pricing higher with larger margins for a period of time when rates go back down to recoup. In this market, we are going to see a lot of that. A lot of that. And many lenders are burying themselves at the moment and will not be able to get out of it. So essentially, any lenders who have said, hey, our business model right now, what we're going to do in this volatile market is we're just going to cut our margin and we're just going to be super competitive with the idea that, oh, if I just win all these deals, that's going to be great. And we'll just be negative on every transaction in the open market. And we're just going to bury ourselves deeper and deeper and deeper. Well, what's going to happen is once the rates do decide to take that turn and they start to go down, they're going to have to recoup all of this negative. So, let's say they started, let's say it was March, they started getting negative and chose that model, and they're just building this negative up and up and up and up and up. It's going to take them so much longer to be able to recoup this amount. So any loans they do after this period are all going to be to recover that amount that they are in the negative. So what's going to happen, especially in this market where things have been way worse than they have historically than many, many years, is you're going to see lenders for, some will be for years, some will be for 6 months or whatever it is. They're going to have to just simply recoup all of this negative that they've been, essentially getting hit with on all these loans in the open market. Okay, so just expect a lot of lenders. We've already seen a bunch shut down, close shop. A big non-QM lender, Sprout, completely just closed their doors. And a lot of these lenders that, have decided to choose this route, which, historically has never worked, especially in this market where it's way worse than, other markets we've seen. You're going to see them either shut their doors or, I don't know how they're going to get out of, they're going to need some sort of relief to help them get out of that negative at that point. Okay. So next one is, do different lenders have different investors? No, there aren't like different investors for different lenders. So how it works, okay, is it's an open market. It's a collective price for all. So essentially these investors get together, however many of them, and then there's a dictated amount that will be paid for said loan. And it just, essentially there's probably, at this point, it's probably electronic as far as cost per loan. And it spits out for all the different, loan amount, all these different LLPAs that are in here, loan amount, loan purpose, credit score, all that stuff for all sorts of different loans. Okay, so there's a collective price for said loan. So what one investor pays to one lender is the same amount they're going to pay to every other lender in the entire country. Okay, so really the question we got to ask ourselves is, what is the lender margin? Okay, so going to the next one, how do lenders determine, or actually this is how do investors determine rates? So they will determine rates. Think of the 2 R's: return on investment and risk. Return on investment and risk. So when a loan is evaluated, it's based on the return of investment and the risk involved with that loan. So if they're presented with 2 loans, and let's say one loan is a 700 credit score on a $300,000 loan for 7%. Same situation, but this person has an interest rate of 5%. Which loan are you going to take as the investor? The 7%. If you did not answer 7%, if you're thinking about return on investment, okay, same person, same qualifications, same loan. One's paying 7, one's paying 5%. You want the 7. You want the larger return. Okay. Now let's say you have 2 loans, same situation, 700 credit score, $300,000 loan amount, whatever, 7%. But then you have 620 credit score, $300,000 loan, 7%. Well, or let's say it's 5%. You want the 700 credit score with 7%, larger return, a larger return, but you're also getting less risk. Okay. Let's flip the interest rates. Do you want the larger return with the 620 or do you want the less risk with the 700? You want the less risk because you still want to have some sort of return. So you'd probably prefer the less risk at that point. But some investors may counter that and say, well, I may be willing to go ahead and take on the 720 because I do like the return on that. But the majority are going to take the less risk. Okay. Let's do a great one. You have someone putting down 20% and another putting down 15%. Both do the 700 credit score, 300 loan amount, all the same criteria. Which one do you want? A lot of people will say the 20% down. But the answer is the 15. Why? Mortgage insurance. Mortgage insurance is extra money paid to the investor because it has a higher rate of default. So even though it has a higher rate of default because of the standpoint of they're putting down less money, the investor still wants that loan because they're getting the mortgage insurance tied to it. So at least they're getting something extra. Whereas, let's say it was 5% down. They at that point would probably take the 20%. You can also kind of weigh out the option of, hey, 5% is pretty high, so the risk might be a little bit more there than what I want. And some may say, okay, well, I want to take on that one and I'll try it for the larger return. It just depends on what an investor's thinking at that time. It just depends. But at the same time, again, that's kind of the mentality you have to have when you consider pricing risk and reward. Okay. I'm sorry, risk and return. I guess rewards is return. Okay. So with that R&R mindset, I want the highest rate of return at the least amount of risk. That's their mindset. So right next to that, I have, this is where you will see the best pricing at loan to values of 81 to 89%. Why? Because you see someone who has assets, they have 10 to 19% to put down and some reserves typically. And they're also going to pay the mortgage insurance, the extra money to the investor. So with that mortgage insurance, they're basically getting, hey, if you were to default, I'm at least recouping something. But again, you have assets, you have reserves typically at that point, and you're getting mortgage insurance. It's a real win-win versus having someone put down 20% just to get out of mortgage insurance. But then also once you hit 75% or less, again, the risk really goes away because you could, as an investor, if they did default, after 1 year, you'd be able to take that loan, go ahead and bank could go off and sell that property and easily make the money. So you're making that money back, probably then some, and you get to keep that money. And then borrowers are with less risk are rewarded per LLPA. So essentially, when you have better qualifications, obviously, you are going to get rewarded with less loan level price adjustments. So think of a loan level price adjustment as a hit. There's a hit to your pricing for one of these reasons: loan amount, loan purpose, you're waiving escrows, credit score, things like that. Okay, so you're going to get hits for that. So the less risk, the less hits you're going to have. So it's a good thing. So the more qualified, the better. And again, mortgage insurance is extra comp given to the investor. Now, Ginnie and government loans are guaranteed by the government. Okay, so that does make investors feel nice and warm inside. They're like, hey, I like the fact that the government's going to guarantee this for me. So this is good. So that does mean less risk. Again, with conventional loans, and if you have very good qualifications, you will be rewarded to where pricing can be better than FHA, VA, or USDA. So it just depends on the loan. But again, typically, if you're going a government loan, FHA, VA, or USDA, all under Ginnie Mae, okay, the government's guaranteeing it, it's less risk. you're typically 620 to 680, or some event, some economic event happened to you. I had a bankruptcy, I had a foreclosure, I have to go this route. Well, the government's going to guarantee that. So that means less risk there. That's why they're going to give a little bit better rates, typically in that 680 to 620 range. But remember, rates are still dictated by the investors. So investors may say, okay, this is backed by the government. I'm more comfortable giving a little bit better interest rate. But you're still a six, like this loan has a 630 credit score versus another loan I can go buy right now, which is a 700 credit score and much better qualifications. So in the open market, someone's going to buy it, but at the same time, the set pricing for that loan, it's probably not going to be just as good of pricing as it were to be for a 680 client, we'll just call it a FHA loan. You're probably going to get better pricing at a 680. So most lenders will create their own loan level price adjustments. Now, on those loans, okay, so you can have two FHA loans, you can have multiple VA loans, but that's in like very certain circumstances. You can't just go buy a second home with an FHA loan or a VA loan, okay? At like used as a vacation property or an investment property. There's very particular reasons where you're in a primary residence and I'm moving to a new primary residence. So I still am gonna have two FHA or two VA loans, for example, which is different than, again, going and buying an investment property or a vacation home for a second home or whatever. So you're not going to be able to waive escrows. Your DTI, what's it called? You're going to be buying the home as your primary residence. Typically, you can do a 1 to 4 unit residence. You can do a condo, so you'll have some, but for the most part, most people are buying their primary residence here in occupancy, and then the property type, 1 to 4 unit or condo, for example. Again, it's not going to range as much as it would with conventional. And your loan amount or your loan to value, no one's really doing VA, FHA, USDA loans with 20% down. Most are going to be within 10%, and I would say pretty much the majority are 5% or less. That's what you're getting. So you really don't have that much of a difference here in LTV loan amount. LTV or CLTV. Loan amounts, you may find one for 100,000 is going to have a little bit less payout than one for 300,000. Think of return at that point. Okay. So that's, again, we have to think more like an investor. Okay. Now, things for investors and lenders to keep in mind. Okay. So this is going to be with pricing. So APOR, the average prime offer rate, used to be set by the FFIEC. Now it's set by the CFPB ever since 2017. They gave control over the CFPB. So this is not much of a consideration, but still something to consider. Okay, so what I mean by that, a lender is allowed to charge the borrower 3% in fees between discount points and origination. Okay, so there's a high fee test. Basically, it's 3%. So if the rate pricing is within 2% above the APOR, the average prime offer rate, you get a 1% exclusion. So essentially, a lender can charge 4%. If you're within 2%, then you can charge up to 5% because you get a 2% exclusion. If you're within 1%, you get a 2% exclusion. If you're within 2%, you get a 1% exclusion. So if you're within 1%, you can finance you can charge 5%. If you're within 2%, you can charge 4%. Okay. Sorry, I got that spun around. So this essentially allows the borrowers to get a lower rate. Okay. Right now in this market, everyone's able to get a 2% exclusion. Okay. So it's not like I'm not really seeing anyone who's getting a 1% exclusion at this point. Some people might be seeing a 1% here and there, but for the most part, just about everyone's seeing about 2% exclusion because the APR is super high and pretty much where rates are, everyone's within 2%. Typically, everyone's getting a rate within 1%, and everyone's paying points at this time that we're in with where interest rates are at. So the point here to consider is that if the rates are to go super high above, okay, borrowers could be limited in certain instances where they may need to pay extra. Okay. So let's say someone, needs to buy the rate down, 3% in this market to qualify. Well, in other markets, maybe they only needed to pay 1% or 1.5% because the cost was cheaper. Let's say they have a 620 credit score, pricing's just atrocious. They're getting ripped a new one. Okay. And they have to pay 3% for that loan because the open rate price right now is just horrible for their loan. Okay. And so if they were to have that exclusion, okay, it would allow the lender to charge them 1% more so that they could qualify to go buy a home. Whereas if they can't, they would be limited. Again, right now, no one has to worry about that because everyone's within at least 2%, if not pretty much everyone's within 1%. So no one's really worrying about that now. But when we get into that lower rate market, you'll see a lot of that. You'll see people that are outside of the 2% because, the APOR is at 2.551 or whatever it is on a 30-year mortgage. So if in actually a place where you can find that, it's actually pretty fun. They publish it here. and this is how they publish it. In terms of 1 all the way to 50. I mean, this is the link. I don't remember how I got here, but there's the link if you want to kind of jot down this entire thing. And then you would just be able to scroll all the way down. And I would say, okay, it gets published on the first of the first Monday or on the Monday of every week. And I would just go here. So, this is 50, 49, 48, 47, 46, 45, 44, 43, 42, 41, 40, 39, 38, 37, 36, 35, 34, 33, 32, 31, 30. So I actually can't see it because my Zoom screen is popping up. If I scroll all the way down, maybe I can see it now. Probably in this ballpark. It probably is like right about here, 5.375. And then it drops off to 4.7, which is probably 20, 29, 28, or whatever it may be. So again, everyone right now is for the most part within 1%. There's some people that are getting outside of 1%. It might be in 2%, but again, no one's outside of 2% at this point. We're not seeing anyone at 7.37. So everyone's pretty much in the clear here. But in this market, again, there's no worry since rates are all within 1%. And yes, they're all within 2% as well of the APOR. For the lender, this may be a consideration on some loans to drop their margin for certain credit scores. So let's say, hey, we need to qualify more people because volume is down. I mean, mortgage refinances are down 83%. Purchases are down 18% right now from the last recording we had. So some lenders are probably saying, hey, our FHA 620 loans, we're going to kind of drop our margin a little bit to bring in some more business. I mean, that's a very smart move so that you can go ahead and draw in some more business. And that way, people can afford it. Again, right now, anything on a government loan, you're going to be within 1%. So if you are, you're going to be able to charge up to 5% of the actual loan amount. So that helps people to, qualify more. So reducing the margin there may be something to consider to help more people qualify. Okay, so now we're going to talk about refinances. Okay, so when an investor buys a loan, okay, let's say they buy a purchase loan, for example, they're buying a Freddie Mac, some like a Freddie Mac loan, okay, and it's a purchase loan, and they go ahead, they pay for the loan, they're going to get some sort of premium check cut back to them from Freddie Mac, or if it was, Fannie Mae, Freddie Mac, FHA, USDA. They're going to get a premium check cut back to them. Okay. The borrower refinances within 12 months. The investor typically has to pay that check back and actually potentially lose money. So in this market, we will see rates not go too high, ideally. And that's because if everyone refinances within 1 year, they will have a ton of money that they're going to lose. Okay. And then at that point, then investors are in the negative and only the investor gets hit, not the lender. So when the lender does the loan, they're basically saying, hey, here's the loan. Go ahead. Who wants to buy it? Investor says, I'll buy it. And that person refinances. Okay. Lender saying that's not my fault that they want to refinance. They want a better rate. So the lender doesn't get hit. They don't get charged. Nothing happens. Only the investor gets hit. Here's why. That premium check gets factored in to their profit of what they're saying we will pay the lender. Okay. So if they're already factoring that premium check and someone refinances, now, it's not like, hey, we're going to pay you 103% for said loan. And so essentially you're going to pay the, lender margin or whatever it is that's included in that. So we're going to pay 103% for said loan. And oh, cool. I'm just going to get this extra money. So I've already kind of like factored that's just extra money that I'm going to get. Cool. If I don't use it, I lose it. The person refinances. I don't care. It's not how it works. It's actually very crucial to investors because they don't want to be out money. So I'll get into the inverse pricing in a second, but here's a great example. So let's say we had a 4.75% loan amount, and we say the purchase price was $100,000. The investor's paying 103%, so $103,000 paid to the lender. Okay, let's say they get a 1% premium check or $1,000. Okay, 1% of 100,000. So they're getting $1,000 premium check. What that is basically like, hey, I'm recouping from the 103% that I paid. So I've already factored this in. I'm willing to pay 1% more if I get a 1% premium check. I don't actually know the typical amounts for premium checks, but it's irrelevant. Okay. So they're saying, hey, I'm already planning on recouping this money, so I'm willing to pay more. That's the mindset. It's not, hey, I'm just getting this like extra money that I'm going to get. Okay. So they get this $1,000. So what they really pay in their mind is $102,000 in this example. Okay, so really what they paid is essentially $2,000 over, unless someone defaults, for example. That would be something that they have to go sell the home and go through that process. But typically they're going to get the actual loan portion back. It's the part above the loan that they pay. So they really pay $2,000 for that loan. So if that person pays, let's say they refinance they refinance in 6 months. So 2760 is roughly what I calculated paid interest on an amortization schedule. So right now it looks like they'd be profiting 760. So it'd be like, okay, cool, you profit 760. The problem is they actually have to pay this back. So now at this point, they're actually negative 240 because they have to pay back that premium check. At the same time, there's also some fees and some other things that are involved. So if they have to pay a penalty fee or whatever fees extra that they would have to pay with that puts them deeper into the negative. So again, there's more to it, okay? But that's essentially the idea. So especially when these rates get lower, your interest payments also go down. So if, we see, rates at 4% or whatever, but we're in a market where, rates are going down, the odds of them wanting to, they're going to want to give you more incentive at the lower interest rates. And they're going to want to do that because of the standpoint that they don't want to lose their premium check because you're just going to go ahead and refinance again. So if they, again, for 1 or 2 loans, no big deal. They might lose, we'll call it $1,000, or, imagine when the loan amount's much larger, and, they lose, thousands of dollars. Well, they don't want to have to keep doing that for so many loans that they're buying. So imagine if you're buying 100 loans and 90% of them all do this, you're negative on pretty much all of them. That's bad. That means you're going to be out crap ton of money, especially on the larger loan amounts. So now I'm in the negative, I'm in the hole, I have to recoup. And so now you have to buy out more to, recoup those ones. And then that's why investors want rates to stabilize. And that's why they also want to give you incentives to buy lower rates, which gets me into the next point, which is this is where you see inverse pricing. Okay. So you will see better pricing at lower rates to reduce the risk of refinance and separate the higher rates more from the lower rates through inverse pricing. And so essentially you'll pay a little bit to lower the rate a lot, again, reducing the risk of refinance. So here's kind of example of what you would see. So let's just put like 4.125, 4.25, 4.375, 4.5, 4. Bear with me, just kind of doing the normal rate table here. Then we'll go up to 5%, and then we'll go up to 5.125 and 5.25. Okay, so we'll just say here. So let's say that we're charged. This is 2.5% is the cost. This one is 2.25%. This one drops down to 1.75%. Then you see 1.375%, 1.25%, and then you see this drop to 0.75%, 0.5%, and then you see 0.125%. But then you see these start to go up, and then it goes back to 2%, and then it goes to 1.625%, and then 1.5%. And again, I can kind of, do this whole thing. I'll just, keep it short. For example, 1 or 0.25, then we'll go to, 0. And so 5.375, 5.5, 5.625. So you would see here, this is 0.125. So you're like, oh, okay, 0.125 is 4.875. But the next lowest rate is 5.625 at 0. So this separation is huge because, heck, you're almost a full percent. So if you're going almost a full percent or almost a full 0.5%, whatever it may be, that's a lot of money in payment. That's a big difference from qualifying. So most people will say, hey, I'll pay the eighth, or I'll pay the quarter, or I'll not 25%, or I'll pay the quarter, or I'll pay the half, or whatever to get the lower rate, which again, they do this so that you can take the lower rate because there are the odds of the rates going that much lower in the matter of 1 year are not as likely. So that means they get to keep their premium check and you keep the loan longer and they make more money. As a lender, you're a consumer. I want to help you. Lenders don't get hurt. So if rates go down, I want you to refinance because I want to help you lower your rate to lower your payments. So it's not necessarily about the rate, it's about your payments. I want your payments to be cheaper. I want you to pay less in interest if you can. So just a think kind of what's going on right now is essentially investors are basically getting freaked out because they're like, man, everyone's going to refinance here soon. So you see, hey, if we take rates too high and everyone refinances, we're just going to be out money. So they do inverse pricing, number one, but they also don't want to just like slam up the rates because if they do and rates go back down, they start to take their turn. Because the other thing is the government, to stimulate the economy, is they want real estate transactions and they love mortgage transactions as part of that. That's a huge part of the housing industry. So if you're doing a lot of mortgage transactions, well, to stimulate the economy, they drop rates. More purchases and a lot more refinances because now everyone's going to be refinancing again because of people who just bought homes or pulled out equity of their home to be able to pay off debt. So when you keep that in mind, investors are like, if I take rates too high, I'd rather let them go down steady and kind of like let it progress for some time instead of just shooting them up and then coming back down because then we're just going to all lose money. So again, ideally, we shouldn't see money or we shouldn't see rates theoretically, we shouldn't see them just spike up to 8, 9, 10%. But at the same time, it also depends on an investor's budget. So let's say investor, I don't know, makes, has a budget of like, 2 grand. Sorry, I have like a percentage of there. So 2 grand. There you go, 2 grand. And these are their expenses, but the inflation rate goes up. So 2 grand did meet their budget, but now they need to make 2,500 to meet their budget. Well, the 2 grand obviously no longer does it, and you can't do anything about loans that have already funded. So you're going to look into like whatever your future loans are that you're going to buy here, like today and tomorrow in the open market. You want to make sure that you're going to meet your 2,500. So rates need to go up to meet your budget. And again, the other part is if the government needs real estate to stimulate the economy, that's where investors are kind of put into a tough spot on what they'll get back. Because the economy needs to be stimulated, but they need to pay their budget. So it's a very tricky game for investors when it comes to pricing out interest rates and things like that. So just a lot to consider on that front. As you can see, there's certainly a lot involved with just how to price a loan and where the investor mindset is with it. The next thing is default. Okay, so this is more of a lender thing. So just like on a refinance, the investor only gets hit. On a person who defaults, the lender is really the only one who gets hit. So when a lender loans money to someone and that person defaults within 12 months, so they taken that, charged their card, went to the open market, they sold it, and typically when they sell it, there's some sort of agreement with that loan. Okay, so there's an agreement. The person has to be in the loan for at least 12 months because of the refinance stipulation. They want that. But again, the lender's not going to get hit if they refinance because then they're paying them all of their money back. If they default, the lender's not paying them their money back. That's the difference. So the lender only gets hit in the default period, not if they refinance. Okay, so the consumer defaults. Well, the lender now has to pay back the investor, just like the investor paid back the insuring entity for their premium check. But when the lender goes ahead and pays them back, they have heftier fees and penalties for the fact that the person defaulted, because then they look to the lender and say, you should not have essentially lent this person money. And then we obviously bought it from you. So when you do sell that loan, keep in mind, you are sending a package of everything. So everything is packaged up, everything that is requested from every guideline and everything that you have to package that loan up and deliver it to the investor. Let's keep in mind, the investor also does not want someone to default. Okay, it's not like they're getting hurt like the lender. Of course, we've already established that. But even though they don't get hurt, they want the return, and they obviously would not be getting that return. So the investor will pay typically less for less qualified people, okay? Even more in particular, for government loans, they will typically pay less for a 620 score versus a 680, for example. So companies, what they'll do is they will set pricing with loan level price adjustments. And they want to do that because, again, they're getting, as a lender, we're getting less money from the investor. Again, it is nice to know that it is guaranteed, but we want to be able to still get our money. Okay. So we would have to charge the client points, is what it is. But the companies that will set pricing for government loans to be the same for all credit scores and not factor in their loan level price adjustments, because again, a very, very few companies do that, are just shooting themselves in the foot, because then their default rates, if their default rates are higher, so if you're not going to be strict and you're just going to lend to everyone and you have these higher default rates, you will actually potentially be put in a position where you could lose your license to lend for FHA, VA, or even USDA loans, as well as Fannie and Freddie for conventional, but you could actually lose your license if you have so many defaults. So to put yourself in that position, you either have to be really strict with those credit scores that you're going to lend to, so you're going to have a ton of overlays, or I mean, you're just going to say, screw it, I need more applications, I need to close more loans, I'm going to risk my license to do it, which is a terrible play because if you risk your license, there's a good chance you're going to lose it because there's certainly a lot of loans that could be lent out there. It's just they're not compliant. So that's, again, an even bigger issue in today for lenders that aren't abiding by the guidelines and in this market risking their license for business, which I mean, if you are hurting like most lenders are because volume is down, you might be willing to take some risks to stay afloat. And that's one thing. The other side of it is, hey, if you're a big enough lender where you don't need to take those risks and you just, hey, bite the bullet for the remainder of this time and just let it drag out and then wait till lower rates again, you're going to be fine. I mean, there's going to be ways that you can make it work. You reduce staff or things like that, and then you repick staff back up, which is normal. But if you're going to risk your license now to do that, that's probably not the best business model for those larger companies. Smaller companies that have to risk their license is a completely different situation. Okay. So here's kind of an example that we're going to go over, and this involves lender credits and margin and things like that, so you can have a rough breakdown. So we're going to go here. So a loan amount, I'm using a loan amount of $200,000 in this example for the profit side of things. This side of things, I don't even have a loan in here because it's irrelevant. Okay, so first we'll say rates. Okay, so here's rates. So all right here I have 4%, 4.75, 5.5, 6.25. Basically, you just see a low and then 3 kind of within 0.75%, just so you can see lower, middle, high. Okay, that's all I was going for. Okay, just a random example. Okay, investor. So this is the first part. So payment for loan. So let's say that investor was willing to pay 98.5% for this loan, 101, 103, 105. So this is the percent paid for the loan. So of said loan amount, they're going to pay this to the lender. The first thing we're going to deduct for the lender's pricing is going to be their margin. So the average margin on any loan. So if you took all the loans and you said, what's my average margin? What's the average margin across the country? 3.5%. 3.5% is pretty much the solid average margin if you took every loan across the country over years. 3.5%. They actually would have been probably higher way back when, but post 2008, 3.5%. So after that 3.5% is deducted, or that 3.5% is deducted, or whatever their margin is, you would see the rate pricing for the lender. So 95, 98, 100, 102. Okay. So how do we get this, okay, to 103.5 so we can have our margin? Okay, so we see this is the current prices, but we need our margin of 103. Well, here's our margin of 3.5%. Here's the pricing that we're giving out, which is 95%. Okay. We will charge the borrower 5 points in this example to bring us to 103.5. If it was 98 plus 3.5, again, it's this minus this equals this. So this plus this, what's the difference of 103.5? 2% we're going to charge the borrower. In this example, this one is a par pricing example. So at 100% plus the 3.5, we're not going to charge anything to the borrower. And over here, we're actually going to give a credit of 2% to the borrower. Okay, so this is what they're paying. We're backing out our margin to show our pricing for the loan, and that difference comes from the client. Or in this instance, the lender is going to say, okay, we're going to give you back money. In this case, we're not going to just take more money from you. We're going to give it back. to make sure that we meet our profit margin. Okay. So then we go over here. So we know our profit is 3%. Okay. So what is 3.5% on average? Okay. So if we're using 3.5% on average, what's 3.5% of 200,000? So here's $7,000. The first thing a lender does when they go ahead and they start paying out what they need to pay out from that 7,000 is they pay the loan officer. So the average loan officer compensation across the country is 1%. So you would say 7,000 minus $2,000. The next thing is anything that the branch needs to pay for. So branches, they vary I mean, there's a million different things that branches could be paying for. What's the size of their particular branch location? Where are they actually located? Are they a franchise that has to pay back into, the actual company? Are there fees for that? What sort of fees are kind of involved per loan? On average, it's about 1,500 to 2,500 bucks per loan. Okay, so most lenders on a super small loan amount will actually be losing money. But if you do a sheer massive amount of loans, you can reduce your monthly expenses because you're doing so many, your volume is so high. So people love jumbo loans and things like that because it helps them to be able to pay more of the fees and expenses. So the lower loan amounts, they can reduce the amounts that they have for fees and expenses for the branch. So they would have to pay out less as a percentage of the loan. But we're just going to use $2,000 in this example because it's kind of an average between 1,500 and 2,500. So right down the middle. So we'll say you had to spend $2,000 there. Now we're going to go into discounts. So they're going to go ahead and we're going to give a 0.5% discount on this loan. 0.5% of 200,000 is $1,000. So here you would see total profit of $2,000 with a 0.5% discount on this loan in this example. Now, if there's extras, I know Movement, is giving 50% of our profit margin to nonprofits. Other company, I mean, I don't know about other companies, but I'm sure there might be one or two others out there that also do something similar with part of their profit margin. But again, Movement's kind of that's our thing. Is we give out, we're big in the philanthropic space. We want to provide for, those in need, help those in need, do what we can. So we give 50% of our margin to that. So as you can see, this is a dramatic impact because if we're giving 1,000 of this $2,000, our total profit is $1,000 for said loan to do all this work, to go to open market, to sell the loan, and then to come all the way back and just make $1,000. So if a company like ours or a Loan Depot or a Quicken Loans, not to say we're all the same company, just I'm talking sheer size. Don't relate these companies. Okay. They have no relation, take away opinions of anything. We're just talking about a business itself from profitability. Okay. The bigger companies, when you see 35 billion dollar company, $100 billion, whatever billion-dollar company you are, the amount of loans you would have to do with, if you did have any extras or you are giving discounts is a ton of loans. It's got to be a lot of loans. So just imagine, let's say the average company that doesn't give anything. Okay. And let's say, you're paying your loan officer 1.25%. Okay. Takes us down here. But now you're giving a 1.5% credit. Uh-oh, we're in the negative. We don't have a buffer. And we go to sell this loan in the open market, and this price goes down. So let's go here and let's just say this is now 103. Oh, shoot, I didn't translate it over. So 103. So I'd go here. Oh, and do that like that. Okay. So this plus this. this plus this minus that. 102. Okay, so now I'm at 102. So then I'd have to do 2.5%. Sorry about this. This times 2.5%. There you go, $5,000. But I gave a 1.5% discount. I'm now out $2,500 in the open market on this loan. Holy moly, that's a big chunk. Even if it was 0.5%, I'm out $500 on this loan without giving any sort of donations with the extras that I would normally would. So a lot of people are in the negative in this position if they're paying out more for their loan officer or if they're given discounts. Now we're going to go over here and we're going to switch it up. So when we switch this up back to 103, there you go. And we're going to say we're going to drop our margin. Okay, so we're going to drop our margin to 2.5% to be aggressive. Did you notice this on the right? This immediately went down to 2,500. So right now, let's say I'm not paying anything and we have a standard 1%. Okay, right now I'm at $3,000. No different. I just went down. Now my margin is 2.5%. I'm down to $1,000 on just dropping my margin by 1% on this loan with no buffer. Imagine giving a 0.75% discount. I'm negative 500. Same situation with the open market. If the pricing gets worse, you could go to the open market negative thousands and thousands of dollars. Now, imagine those companies that are lowering their margins and giving tons and tons of discounts all the time. And you do that for a long period of time, you're going to be building up such a negative pit for yourself that it's going to take a long time to get out. Because just as many loans that you put in to be able to become a billion-dollar company, you are putting in, again, a lot of loans comparable to that to really reduce yourself from being a $1 billion company or whatever, however many billions that you are worth. So if you're going to reduce that amount that much, holy moly, you're going to really be in for a shock come once rates start to turn. You're going to be stuck in a recoup phase for quite some time. And then that actually drives away business, because now when this market turns and rates start to go down, they just start going. They don't like go down and go up and down and up and down. When they decide on a direction, there's going to be a tipping point and they're just going to go down. Okay. So if rates just decide to go down and you're stuck in this higher rate market, when it comes to refinancing, you are going to lose so much business that you'll be stuck in this point that we are in right now, where 83% of refinances are down. It's going to feel like they're still down for your company. And then they're going to go ahead and they're going to have to just continue to recoup and eventually lower those rates to, again, put themselves in a position where they can make some money. So it's going to be a very hard fought time and years for them to recoup. And the worst part is that if they haven't shut down and they were able to survive the next low rate phase, they might be trying to recoup throughout that entire low rate phase all the way into the next rate hike cycle. And if they are doing that, that means they had to lower the rates to just get enough refinances to get them out of the negative, to just go back into the negative on the next high rate cycle in however many years, whether it's 2.5 years or 3 years or whatever it may be. That's a bad position to be in and to really dig for yourself. So that's how rates are set. That's why, you can only give so much in discount. Lenders aren't really profiting what people think. And lender margin, takes a lot of effect into that. So, if you were a consumer and you're considering a lender, I mean, again, you want the best deal. It is what it is because you don't get affected. But at the same time, for lenders to stay in existence, it is good to know that there is only so much that a lender makes on your loan, and it's not tens and hundreds of thousands of dollars. Now, if you are in a higher loan amount and we're talking like, oh, we're doing a $750,000 loan. Okay, here you go. You see lenders, again, due to the sheer size, look at that 1%, 3.5% margin. They made 16,000 on that loan if it's 1% with no discounts at 3.5% profit. But again, if it was 2.5 and we went over here, I mean, I don't think I have this factored into that. No, I don't. Okay. And they were paying 1.25 and they're giving a percent on the loan. Look at that. This one's down into the negative. And so if they decided to reduce their margin, pay the loan officer a little bit more, and give a discount of 1%, now they just did your loan again for free. So free loans are, again, great for the consumer, but there again, it's the whole point that there's not as much margin as people think, or not as much room in a loan for a lender to actually profit. So they have to do a lot of loans. So just something to consider. Now we understand rate pricing. If you have any other questions about rate pricing, let me know. Shoot me a call. I'd love to share, talk through any questions that you may have. Again, I tried to boil this down into consumer terms to help you better understand. Again, if anything seemed too complex or there's something you didn't understand, let me know. I can definitely talk quite a bit. So I know a lot of what I say can go over people's heads, but I want to make sure that you understand personally. So don't hesitate to reach out. Feel free to reach out to either either me on Facebook. You can go ahead and send me a direct message or Instagram. If you are a realtor, I do have an exclusive Telegram group. I'd love to be able to have you in part of that group, so that you can be able to get any updates that I release as well throughout the week and throughout the month, and any exclusive content that I will release firsthand to make sure that you have the information right at your fingertips. So I hope you enjoyed this. Hope you have a wonderful day. Hope you know a little bit more about rates, how they're priced. And again, I'm always here to be able to answer questions, anything you got. Thank you for tuning in today. I am just so grateful you gave me the opportunity to be able to educate you. For you taking the time out of your day, it means so much to me. And it does for the sole fact that we have a big problem in this industry. This industry, with what's going on in our economy and the mortgage industry in relation to it, we have so many loan officers going on social media and playing the telephone game to real estate agents and business partners who are further spreading false information. And there's a lot of false information out there. I'm just here to help. I want to be able to educate people. And so I created this YouTube channel. So if you would be willing to support me, subscribe to this YouTube channel, like my video, share it with a friend. I'd love to be able to help you. And the only way that I earn my living is being a loan officer. So I don't have to be your loan officer, but if you wanted to give me a shot, my information will be below. Whether you're looking for a question to be answered, or you're looking to purchase or refinance your home and you would like to give me an opportunity, either or, it does not matter. I am here to help you, whatever that means. So again, thank you for tuning in. May you help support this channel to educate consumers out there to know how to do mortgages right. If you're in a bind or you're in a tough spot or you think something's going on or you're not getting a great deal or whatever it may be, and you just want me to answer a question, give me a call, shoot me a direct message. I would love to just help you. That's it. No strings attached, no nothing, just someone who wants to help. So help me correct this industry and what's happening today with so many people being salesmen and very few loan advisors. There's very few of us who actually want to advise and help and protect people, and we live that out with our business. So help me to do things right, to help do my part to do things right in this industry and to get out this education for more people to be educated, to know more, to have more knowledge of what to do and what to ask when they go into their next mortgage transaction. So again, thank you, and I hope you have a wonderful day.